Chipotle is going to have one of the largest ever stock splits in history, 50-1. So on June 6th, the board of directors is going to come together and they're going to do a final vote on the stock split. The stock is currently at $28.75, and it's really important as an investor that you understand what a stock split actually does. Don't fall for the normal person saying, oh, the stock is now cheaper. It's not cheaper. It's the exact same value. The only difference is the price goes down. So how does the price go down? Well, everybody who has one share of Chipotle will get 49 additional shares. They'll be left with now 50 shares, and this price will be divided by 50. That'll make this price roughly $58 per share. Okay? That's all that means. So now you might sit there and say, well, Paul, wait a second. 58's a lot less than $28.75. Very true. But now everything on a per share basis with the company will now divide by 50 instead of by 1. So let me break this down a little bit further for you to understand, because it's a very important point. And the only reason stock splits are done are basically psychological. So let's say hypothetically we have a company that makes $10 per year and there are 2 shares. Now every share gets $5 of that, right? $10 in profit divided by 2 shares equals $5 per share. Now let's say they do a 5-for-1 split. So now every share gets 4 extra shares. Now they have 10 shares outstanding. Guess what? They still make $10 a share, but now every share gets $1. Now before you had 1 share, for example, you got $5. Now you have 5 shares getting $1. You still get $5. It's the exact same total amount. It's just less per share. That's it. That's like taking a pie and you have 4 slices and you say, you know what? We're going to cut that pie into 8 slices now. The size of the pie has not changed. It's not gotten larger. It's not gotten smaller. It's exactly the same. Mo, now let me ask this question. What's the most famous company to have never had a stock split, do you think?
Berkshire?
Berkshire Hathaway. Berkshire Hathaway was around $7 or $15 a share sometime in the 70s or 60s. Berkshire Hathaway Class A stock, $620,000. So whenever somebody tells me, Paul, Chipotle stock is really expensive because it's $2,850 a share, you know what I do? I pull up Berkshire. I go, is this more expensive? They're like, well, yeah, it is. I'm like, I get it. 1 share costs more money. But let's look at it this way. Let's look at the market cap of Berkshire Hathaway. $895 billion. $895 billion. Okay? And the stock price is $620,000. Let's go back to Chipotle. Their stock price is $28.76. So according to this, $620,000 divided by $28.76, it's 215 times more. Berkshire Hathaway's share price is 215 times more. So that means, according to this, Chipotle's stock price, market cap of $900 billion means that Chipotle's market cap should be $4.2 billion. But what's Chipotle's market cap? $80 billion. 1/10. Even though the stock price is 200 times larger, their market cap is only 1/10. Why? They have far more shares outstanding. Mo, do you remember why Berkshire Hathaway has never had a stock split on their Class A shares? Do you remember why that is?
I think they didn't want to incentivize people to just go and, because what this does psychologically, this is going to be $58 a share if it splits today. It's going to incentivize people to go and buy it. I don't think that Warren Buffett and Charlie Munger wanted that when they just got going.
That is 100% correct. And do you remember why they didn't want that going?
That one I don't remember.
So they always said, we want like-minded investors who are in with us for the long run. So if we ever split our stock, it'll make people more likely to go in and out of the company. Like Mo just said, the average person doesn't have $2,876 in for one stock. And did I say stock? One stock. And the other thing is they don't want to own just one share. They'll sit there and say, oh, I only own one share. I want to own 100 shares. Okay. Well, now they're going to sit there and say, oh, I can buy so many more shares. I feel richer. I feel more important. It sucks to log into your brokerage account and see one share on there. With Berkshire Hathaway, they wanted that. They wanted people to sit there and say, I'm going to go spend $200,000, $100, someday spend all this thousands of dollars, tens of thousands, hundreds of thousands on a share. That's the kind of person who will sit there for a long time and wait. They don't want the market manipulation by retail investors going in and out.
There was an article this morning that said it's making it more easily accessible for the average investor. That's exactly
it.
That's why Walmart just recently did it. That's why Target has done it. That's why Amazon has done it. That's why everybody does it.
They want more everyday investors to be able to buy more shares. It puts the momentum up in the share price. Because remember, guys, a stock market's basically just an auction house. And the more demand there is, the more people getting into it, the more likely they are to see the stock go up. But also, the more likely you are to see the stock go down irrationally. You're watching this video and you're learning more for one reason. That's to make more money. Investing with confidence takes a combination of the right process that works for you and the ability to handle your emotions. Everyone in the history of the world, including Warren Buffett, has made the wrong financial decision because of emotion at some point in their life. You are not alone in that. But the great ones are the ones who are able to handle their emotions very well. We can all relate to seeing a stock fly high or drop fast, and we worry that we're either going to miss out on those big gains or our stock is going to zero. We've all been there. And again, the right emotions coupled with the right process can greatly decrease those fears. You can focus on the truth behind the numbers and make better and more profitable decisions. And this is exactly why I spent millions of dollars to create the software and the community. I use the tools in the software to help make data-driven decisions so I can understand the fundamentals of the business and understand why I'm buying in order to avoid making emotional decisions in the long run. We've all done this. We've all bought companies because they were cool and the stock price was going up and we had that FOMO and we had to chase that stock going up. And then when stocks are going down, Jesus, that can be a very, very lonely feeling. You're sitting there at night, all by yourself, worrying if the investment you just made is going to zero. You are destined to make highly emotional and likely incorrect decisions that will cost you money when you make a solely emotional decision. It has been proven time and time again that making those kind of decisions will cost you in the long run. In the short run, it can work out wonderful, but in the long run, it can and will cost you. Your job as an investor is to make data-driven decisions to avoid the emotional ones. And with the community of like-minded investors, you can be a part of a group that has their emotions in check. You don't have to sit there alone worrying all night. You can be in the community and say, guys, I'm worried about this. What advice do you have? So you have a decision to make. Are you going to be there alone, or are you going to be with thousands of like-minded people that will help make you better decisions? So for $7 for 7 days, that's the decision you need to make. So click the link below and sign up, join the community, and make better decisions that will lead to more money. So let's go understand Chipotle from an investment perspective. Guys, I'm not going to lie to you. I'm addicted to Chipotle. Mo, remember when the whole E. coli thing came out?
Yep. You wanted to get E. coli.
I wrote on Facebook two things. Well, one thing. I wrote, I'd rather have E. coli than not have Chipotle, and that's 100% fact. Second thing was, I wanted E. coli from Chipotle because I wanted to sue the F out of them so I can get Chipotle. My settlement would have been, just give me Chipotle for life.
Just give me that famous gold card.
That's all I wanted. The other thing was, when the third Chipotle opened from my house within 12 minutes away, I was so happy because I thought to myself, oh, I can now go to 3 different Chipotles and they won't think I'm a weirdo for coming multiple times in one day, because that has happened many, many times in my life, right? And
I've only done 3. I've done 2 multiple times, probably more than 10 times at least.
So look at the revenue growth. This is the revenue growth. Guys, we're going back to 2015, and I'm assuming we're going to share our screen here. We got 4.5 billion, 3.9, 4.8. This is where the E. coli thing happened.
Right.
And it was a little slower, but look at the growth here. And the funny part is, we're up to 9.9 billion from 4.5. The funny part is, when I go to Chipotle now, the lines are easier. And I think the reason is their online sales are just so big. I would want to see a breakdown of online to in-store sales. But I want to see what the same store sales look like, because the other thing is, here are the number of Chipotle Mexican grill stores worldwide. And back in 2015 to 16, it was between 1,780 and 2,010. Now it's 3,400. So it's almost doubled, and sales have almost doubled. So I look at that going, all right, is that really a good thing?
Same store sales are up 8.4% last year on year. That's from February.
Wow.
6th. Yeah.
So I'm kind of surprised by their revenue numbers then. I would have thought it'd be much higher than that. That's very interesting. Yeah. Guys, another thing I want to talk to you guys about. This was I believe it was the Instagram post that we saw Chipotle will be focusing on expansion, setting its sights on opening 315 new restaurants within 2024, totaling 7,000 locations across the United States. False.
Actually, Paul, hang on one second. So Brian Sozzi did an interview with Brian Nickel, who's the CEO of Chipotle, and he said the question was, in 10 years, how many Chipotles will open worldwide? And the CEO said they want to get to at least 7,000 over the next 10 years. So it's not just in the United States.
Oh, okay. So the whole point is, this is all part of why you watch this channel. This is why you're part of this community. This is why we do all of this, is because there's so much data coming out there. It's going to be, I don't blame Yahoo Finance. It's just somebody's writing something. There are mistakes that are going to happen. So that's why it's nice to be your own investor and have your own mindset to sit there and verify some data. So let's go look at their 8 pillars. See how the 8 pillars look. Oh, interesting. I'm actually surprised by this. Guys, so first off, I'm not worried about the debt. A lot of this has to do with the leases. It doesn't bother me at all. Zero bother. But look at this. 110 times price to free cash flow last 5 years. 113 times earnings. Mo, the 1 year, oh my gosh. The 1 year price to free cash flow is 65. The 1 year PE is 64. So I love the fact that their free cash flow of $1.22 billion is very similar to their net income of $1.23 billion. Very consistent. We love seeing that. But boy, is this expensive. And Mo, the funny part is, the market cap to enterprise value is not very far, not bad at all. No. Obviously, with a lower free cash flow, that's what makes it the 5.5. But guys, this is a very big multiple. So why should you pay a big multiple for a company? One of two reasons. One, they get a really high return on their invested capital, which allows them to invest a lot of money back in the business, which this company does have. Look at this, 18.6% return on invested capital last year, 12.3% over the last 5 years. Mo, what were you saying? Yeah, really good.
Pretty good.
So this means when they invest money into new restaurants, they get a high return on that, which means they can increase their free cash flow and earnings at a higher clip. And that's one reason to pay them more. And two is if the company has high growth rate, okay? Now you might sit there and say, well, are those the same? They're not necessarily the same. A high return on invested capital also shows a moat. You look at Apple. Apple's got a really high return on invested capital, but it's very difficult for them to reinvest at high rates of return, especially with a lot of money. But with Chipotle here, they still want to double in size. They can go reinvest in more locations, okay?
Before you move on any further, go to the income statement and look at their net income.
Okay.
Look at what they've done over the past 5 years. Don't remember seeing a company do this.
Yeah, it's huge. 176, 350, 355, 653, 899, 1.23.
That's crazy.
That is crazy. That is absolutely crazy. All right, so here's the analyst estimates, guys. I'm going to analyst estimates on our software. This is the earnings per share. Remember I talked about really growing their earnings per share fast? Look at this, Mo. 20+%, huge. So this deserves a premium. The question is how much of a premium? And by the way, don't forget, $54 a share to 113. This is going to be divided by 50 once they do their stock split. So it's going to go to like $1.10 per share and $2.30 a share, whatever this is. Okay. And revenue growth. Look at this, Mo. Look at this revenue growth. Jeez. Big time.
Huge. From
11.3 billion to 18.4 billion. That's incredible. By the way, what's their gross margin? Let's look at that. Guys, their gross margin here is 26%. That basically means for every order they do, 26% of it goes to profit before overhead and taxes and interest and things like that. That's an incredible number for a restaurant area. And then its bottom line margin is significantly higher, 12.5% last year versus 9.3% in the last 5 years. So we want to make sure that that's a sustainable profit margin. So it leads us to our next question, Mo, which is, how much are we willing to pay for Chipotle? When was the last time you did Chipotle in your stock analyzer tool, Mo?
Oh, geez. Let's see. It's been a while. And
Mine was July of 23.
Mine was April of 23.
Okay. So here are my assumptions. They might be low. They might actually be low. I did 4, 8, and 12%. Okay. Now, if you remember, on our analyst estimates, they're estimating 12% a year for the next 5 years. This is a 10-year analysis, and I'm doing 4, 8, and 12. Now, if they're going to double, I think that's low. You know why, Mo? If they're going to double their locations in the next 10 years, that alone is 7% growth. Then you talk about, so I think I was low here. I'm going to go
I
with
have 7, 10, and 13 in here right now.
I'm going to go with 6, 10, and 14.
Okay.
14 is very aggressive and very high. But actually, you know what? I'm not going to do that. I'm going to do 5, 9, and 13. And the reason being is it's still hard to grow. And a lot of things can happen. I still want to be a little bit more cautious here. Now, profit margin. I definitely got to increase this profit margin. I'm going to go with 8, 10, and 12. Same with free cash flow. And the reason being, they only have 1 year of this really high profit margin. And that's the thing, guys. If you start to see in the next 6 to 12 months that this profit margin is stable, you're going to have to come back here and put it back into your stock analyzer tool and readjust your numbers like we're doing right now. Remember, I only did this in July. This is not very long ago, and I'm already changing my numbers. It's going to change my value because the facts have changed. Remember that. When I usually change my assumptions here, it's because something in the facts have changed, right? That's what's awesome. What'd you do for profit margin, Mo?
I did 7.5, 10.5, and 13.5.
Okay, got it. Now for PE, Mo, they're currently at 65 for both PE and price of free cash flow.
Yeah.
Now, they have a lot of growth potential. They have a high return on invested capital. But they are in a very, the food industry is a very competitive industry, the fast food industry. But this is Chipotle. Is my bias showing up here? Probably. But what multiples did you put on this for your PE and price of free cash flow?
So I'm going to put in 18, 21, and 24 for both of them.
Okay, I did 16, 19, and 22. I'm comfortable with that. I think yours is probably better than mine. That's the thing, guys. That's why we love this software, because it allows people to put their own. If you know Chipotle better than me, if you know the food industry better than me, you should not have the same numbers as me. You should sit there and have, well, unless you sit there and say, Paul, you hit it on the head, which I doubt I did. The whole point is, what's the appropriate multiples to put for this company for 10 years from now? That's what these numbers are. That's what these multiple PE and price of free cash flow is. And of course, guys, I've now started to put 9% in here. That's no margin of safety. It's the market return. Remember, there's no margin of safety in the next numbers I show you, but we need margin of safety because for 3 reasons. 1, valuation is an imprecise art. We don't know. We're never going to come up with we don't know exactly to the dollar what something is worth. 2, the future is unpredictable. We don't know what's going to happen in the future. These are all based on futures that could, what if another E. coli thing happens? What if something worse happens than that? And 3, we're human. We make mistakes, right? Now we get a lot of comments. Paul, and I get this on Twitter too. Paul, why don't you put margin of safety in? Reason being is margin of safety is a personal decision. I don't know if you know the industry, you should have a lower margin of safety. If you know Chipotle, you should have a lower margin of safety than somebody who's just looking at it. Margin of safety is very, very personal. Now, what I will do, after I show this price, stay with me for just 1 minute longer. I will change everything to the margin of safety, changing my 9% return to 11.5, because I feel like, hey, for me to own a Chipotle individually, I want a little bit of margin of safety. That seems like a reasonable amount. The higher desired return, the more margin of safety. So based on no margin of safety, I hit the analyze button. Here are my prices. Oh boy, 530 on the low side, 1,800 on the high side, 1,000 in the middle. And again, like I told you, let me change this to 11.5% across the board. So with a little bit of margin of safety, my price is 443 on the low side, 1,500 on the high side, 830 in the middle. So I'm going to change it on my watch list from 550 to 850 so I can write puts. So guys, if you want to see the 13 stocks that I own, watch this next video. I appreciate your time.